Uncertainty around trade has led to some volatile markets recently, but are there some sectors better positioned than others to navigate this environment? Joining us now to discuss, Himanshu Sharma, Managing Director and Portfolio Manager with TD Asset Management. Great to have you with us. This is your first time on the program. Tell us a little bit about your role at TD.
Sure. So I manage few equity mandates. There are two global equity mandates, two US equity mandates, and there is one globally traded, publicly funded infrastructure fund that I also manage.
Okay, so you obviously have a nice view of what's happening globally, and it has been a very substantial several weeks. A lot of volatility. What areas of the market are looking interesting to you?
So these publicly traded infrastructure names, they look actually very interesting at this point. So these are, for example, airports, toll roads, pipelines, ports. These are the companies. And if you think about it, over the past few months, it has been extremely volatile. And prior to that, investors were focused on AI, data center, Mag 7, those themes and stocks. However, all through this volatility, these infrastructure names have continued to do extremely well. And that is something that I find interesting about the market at this point.
All right, let's dig deeper to those infrastructure stocks. And what makes them unique? Why are they able to outperform such a volatile market?
Good question. So what I would say is that when we think about these infrastructure names, what I would say is that they have, when we think about their revenue streams, they have a defensive portion of revenue and also an offensive portion of revenue. So the defensive portion of the revenue, these are regulated assets or assets that have long-term take-or-pay contracts. So essentially what it means is that it reduces the downside as and when the economy is contracting or if there is a slowdown. And then the offensive part of the revenue participates as and when the economy or the GDP is expanding. So this is a fairly unique characteristics of these companies compared to, say, for example, if we compare it to, say, hotels, restaurants, retailers, any other type of companies where all of their revenue is exposed to the economic gyrations versus these companies where there is a defensive portion to their revenues. So this is something which is quite unique and which is something that we are seeing getting rewarded in the market as well right now. So currently we are pretty much through with all of S&P 500 earnings. However, many of the companies, they talked about tariffs and also about macro uncertainty. But these infrastructure names are much, much better insulated versus the broader market when it comes to tariffs or with respect to macro uncertainty. Again, just because of their revenue profile.
So it sets them up a little more advantageously. What are the risks when someone's thinking about the infrastructure sector?
There are two risks I would highlight. The first part is just the regulatory risk. Every so often, the contracts, they come up for renewal, and regulations, the regulatory assets, they go through a regulatory review. It doesn't have to be negative. It can be positive as well, but nonetheless, it is a risk. The other risk I would talk about also is new project risk or capex risk. So if you want to think about, say, a toll road or a port developing a new terminal or a toll road extending their existing highway or developing a new toll road, these tend to be extremely capital intensive endeavors. So if the projects, if they don't complete within time or within budget, then that can put a lot of pressure on their balance sheet. So an operational or a new project risk can actually become a financial risk for these companies, could even lead to equity dilution. So that is another risk to watch out for these companies.
Important to keep in mind. I think you have a couple of examples for us of specific companies, including one that's in Spain that you're finding interesting.
Yes. So the name is Aena. The ticker symbol is AENA, and it trades in Spain. The company, it is a collection of over 40 airports, primarily based in Spain. And once again, they have a defensive part of the revenue, and we call it aeronautical revenues. So that gives them a downside protection. And then they have a commercial part of the revenues, which participates with any kind of commercial activity at the airport. So for example, duty-free shops, restaurants, retails, car parking, any activity, any sales that take place, Aena gets a cut of it. Since COVID, As we know, the traffic trends have been fairly strong, and Spain is a major tourist attraction. So the company has been posting reasonably robust traffic trends, good cash flow generation, and good balance sheet.
Okay, so that's a Spanish example. You also have another company that transports natural gas.
Yes, so the other name would be Williams. The ticker symbol is WMB, and it trades in US. This name is essentially a transporter of natural gas. They don't produce any natural gas, just a transporter from one place to another. And given how LNG demand has been growing, and given how the power demand is also growing in US, it bodes really positively for natural gas volumes in general, and Williams is a direct beneficiary of that. And once again, this company has long-term take-or-pay contracts, which again, what it means is that there is a downside protection, but also participation in the upside. Now, there are few risks with this company. There are three risks I would highlight. The first one is just once again regulatory risk with respect to their any existing assets or potentially new assets. The company also does M&A, so hopefully as long as they are disciplined, that will be good. And lastly, a small portion of their revenues are related to the commodity prices, so which is natural gas. So natural gas prices is another area to just focus on with respect to this name.